So you get this free. It doesn't matter whether you've had any taxes to pay or charitable contributions or medical expenses or anything. It's free to you. You just take it. It's yours. Or you can spin the wheel and get into the itemized deductions. So itemized deductions are specifically allowed deductions under the Internal Revenue Code. Generally speaking, they fall into the categories of medical, taxes, in basically state and local taxes, both your income tax in the states where there is no income tax, then it's the sales tax that has been paid in that state, and also property taxes. So to the extent you have either real property like a house or personal property like a car or a boat or a plane, all of those kind of taxes are deductible. Unfortunately, we don't double dip when you either get the sales tax or the income tax, one or the other. You do not get both. So you have to make a choice there. The next category is interest, but only interest on mortgages, the borrowings we do to buy a home, or certain amounts of interest for borrowings to purchase investments. Unfortunately, credit card interest is not there. Student loan interest is only here if you can qualify for it up in adjustments. You do not get the student loan interest down here as an itemized deduction. Next category is charity. So gifts to charity, you're able to get deductions there. And hopefully I'll have a little time to spend on charitable deductions a little bit later on. And then lastly, a whole bundle of miscellaneous deductions. Some of them that you'd be interested in would be job search or retraining expenses where you may, or professional dues. So if you're in the National Engineering Association or something like that, and you pay dues for that, you'd be able to deduct those. There are two catches about miscellaneous deductions and medical deductions. And it's that darn AGI again. So the purpose of the medical deduction is for really, if you will, very serious medical expenses. So the IRS takes the first 10%, makes you deduct 10% of that adjusted gross income away from the total of your medical costs. So if you have, let's say that you had to go to the hospital and you had total out-of-pocket costs of $20,000. If you had $100,000 of income, adjusted gross income, you'd have to take $10,000 away from your 20, and you'd only be able to take $10,000 of that expense. Similarly, with the miscellaneous deductions, you have to take out 2% of your adjusted gross income before taking anything out for those miscellaneous deductions. So we come to this, whichever, and generally speaking, unless it's extremely close, and you don't want to be bothered by the thought of being audited, take the higher of the two. And another trick. Here's one of the tricks. Trick number one for you. There's nothing to say that you can't go from itemized deduction to standard back to itemized year after year after year, right? You can change each year. And so let's suppose that you're right on the edge. Maybe your itemized deductions are about $5,500, $5,700. You're saying, darn, I can't get them because, I haven't made it up to that $6,000 yet. Perhaps you can time your deductions so that you can bring a few of those itemized deductions into the year and bring, from either side, from either calendar year. Let's say we're sitting in 2017 and we're doing our plan for 2017. Maybe we can just look forward into 2018 and say, I typically give to charity during this time, or I may have a tax payment or something to make in 2018. I'm going to bring them back into 2017 so that I can get over the hump and itemize in 2017. And now in 2018, when I have very, very little left because I brought some of it into 2017, I'm just going to take the standard. And by doing that, you can effectively increase the amount of deductions overall that you're taking. So if you're on that line, and some of you might be, that's an interesting strategy for you to consider. So from there, we move on to a choice you have between taking a standard deduction. The government basically lets you per individual per individual filer, $6,000, a little bit more than $6,000 per year. So if you file with your spouse together, that's doubled to $12,000. Even if your parents have claimed you as a dependent on their return, you still can take the $6,000 up to $6,000 as a standard deduction, provided that you have earnings up to that level of the $6,000.